Cryptocurrencies are cyclical assets, as many assets are. Most assets are driven by the business cycle. Cryptocurrency less so. It's driven by this cycle, driven by Bitcoin itself, bizarrely called the halving cycle, when supply gets reduced every 4 years, and tends to then lead to a speculative bubble, and then we tend to get a bear market. It also usually coincides with when the central banks have finally stabilized an economy after a bad period. So we saw central bank printing in kind of 2015, 16, 17. That was the period where Bitcoin did well last time. Then the world's economy recovered. Bitcoin did less well. So it tends to be the slight inverse of those central banks. So when the business cycle is looking good, you might want to own more equities than you own crypto. But when you're in this early stage where the central bank's probably going to print more money, you'll want to own some of this. So it has its own cycle. It has huge downside, but the upside is even bigger. So in financial market terms, we refer to as the risk reward. So the average annual return of Bitcoin is about 120% a year. So it's 120% a year in price appreciation. And I think the worst down year in the history of Bitcoin was 45%. So almost every day you enter the Bitcoin market, it's a 2-for-1 risk reward. Now that really works over a longer period of time, a few years. But if you look at a chart of Bitcoin, it always does this. It's an exponential chart. So you need to put it on a log scale. And what happens, magic happens when you put it onto a log scale. Exponential assets on a log scale makes sense. It trades in this beautiful range on this upward trajectory. Now that range on a normal chart looks massive, like down 70, up 700%. But when you're on a log chart, it's like, oh, I get it now. This is just a more volatile asset. But the rewards over time are amazing.
Interesting. And, diving deep a little bit into cryptocurrencies themselves, because there's a whole bunch of different cryptocurrencies out there. Bitcoin, Ethereum. What is the difference between, say, Bitcoin and Ethereum, and why are there so many different currencies?
Well, firstly, Bitcoin was the big daddy. It's the OG of the space. And it was based on the context of money, a store of value, introducing the idea of blockchain, this very limited supply, this hugely distributed network that's incredibly safe. So it has properties that almost no other blockchain has. And its adoption means that its value is now accepted amongst millions and millions of people. So that's Bitcoin. But Bitcoin, because it's so secure and so amazingly built, makes it less fast for transactions. So then back in about 2015, Ethereum came out. And Ethereum solved two things. One, making it faster. And two, adding something called smart contracts. Smart contracts allow you to program the bit of the blockchain to say a specific thing. If this, then what? Those kind of things. Which meant that suddenly you could program this blockchain and create all sorts of things. And that kind of grew for a while. And then we all had the crypto winter, the bear market, in 2018 and 19. And then suddenly out of the gate exploded DeFi, NFTs, social tokens, all of these things being built on smart contracts on Ethereum. And the network effect on Ethereum was gigantic because it was growing really fast. So think of Ethereum more as a software platform for the Internet of Value. And think of Bitcoin as the pristine collateral, the base layer of it all. Then you've got other things like Solana or Cardano, or there's a whole bunch of these out there, Terra, which are layer one solutions. They try and do the job of Bitcoin and Ethereum, but in different ways. There's always a trade-off. The trade-off is security of the network by the number of people who secure the network. So Ethereum has less and it's done in a different way. And then Solana and others have less, but it's super fast. So they change how the blockchain works to increase speed. So maybe Solana's really useful for financial transactions. So there's a lot of this going on in the space where people are solving different needs by different groups. Ethereum is so popular that the costs, called the gas fees, of using it are expensive. So again, some of these others have solved that. But most people want to build on Ethereum because that's where the network is. That's where all the developers are. That's where all the mindset is. But it shifts around. Then there's other ones like DeFi, decentralized finance protocols, which give you yield for your money. And that's a whole different set of protocols. And then there's ones for NFTs and social tokens. They're all different as well. So they all solve different needs. And if you think of it, think of this hive mind of the smartest people in the world of finance, technology, and mathematics all getting together and saying, you know what, we're all going to solve the world's problems. And how we're going to do it is we're going to break up into small groups, expert groups, and solve little bits at a time, all at the same time. That's why it's so fast. We've never seen anything like this before, with the amount of brain power going into this to break down small bits of the financial system, the business model, whether it's IP rights, whether it's how to empower communities, or whether it's how artists can monetize their money. So many things. People are looking at that one specific use case, getting a group of 20 people together, the smartest people they can find, say, right, let's go, raise some capital and do it. It's incredible.
So how does somebody now who is watching this thinking, I want to get involved in cryptocurrency, how do they find a good currency to buy or invest in? I mean, like Elon Musk was a big talker of Dogecoin, and just more recently, Shiba Inu, which rallied, hundreds of percent so fast. How do you decide what's the good way to go?
Simply, you go to how financial market participants look at risk. And this is a really good lesson for people, is when you're learning about something, allocate to the least risky asset to start with. Open a wallet, get some Bitcoin, get some Ethereum, get those two assets, understand them, understand how it transfers, how you store it. And by doing that, you'll suddenly start picking up on Twitter or Instagram or anywhere else. What are people talking about here? And then you'll start getting exposure to all these coins. And you're like, I can't get my head around this. But let's say you want to go out on that risk curve and take a little more risk. Well, then the best way, what I did was I don't know which one of these is going to succeed and which is going to fail. So I'm going to take some of the middle to upper tier of these and just make an equally weighted basket.